So to continue on the foundation, or really the macro environment that really determines and drives all of these models, the first is monetary policy tools, and particularly open market operations. The Federal Reserve uses open market operations to buy and sell bonds in the open market to drive prices, bond prices up and down, and interest rates up and down, to regulate the economy. So that if it thinks the economy is overheating, it's going to sell bonds, the bond prices are going to go down, and interest rates are going to go up, and the cost of capital is going to go up, and it's going to cool the economy. If the economy is falling into a recession, which it could be right now, the Federal Reserve is going to print money, go into the open market, buy the bonds, drive up the bond prices, drive down the interest rates, drive down the cost of capital, and then stimulate consumption and investment by individuals and firms. So the Federal Reserve mainly uses open market operations as the tool to regulate interest rates. Okay, and again, if you look at a lot of your models, there's a risk-free rate embedded in all the option models, all the futures models, all the valuation models. There's a risk-free rate. That's what the Fed manages. The Fed, again, prints money to buy these bonds, driving prices up and down. The Fed sells bonds, again, to drive prices down and interest rates up. And again, what the Fed is trying to control is inflation and hyperinflation, and disinflation and deflation. Okay? And the Fed actually targets interest rates, and it also targets the inflation rate. Okay? That's one of the monetary policy targets that they try to target. And the Fed right now is trying to target inflation at 2% and interest rates at 2%, particularly the 10-year. So it's targeting inflation and interest rates. It also targets gross domestic product. It's trying to target a 3% growth rate in GDP. It's now at 0.7. So the Federal Reserve is off the mark. And inflation is actually negative right now and has averaged 1% per year over the last 2 years. So it's a 1 percentage point or 100 basis points below its target. So the Fed is going to need to stimulate the economy even more, okay, as opposed to raising interest rates. So the goal is, and the Federal Reserve has dual mandates. Full employment is one. The other is stable prices, so not hyperinflation or inflation. It wants to target low inflation rates, but target the inflation rate and interest rates. It wants to mitigate asset price bubbles. We saw the housing price bubble in 06, 07. We saw bond price bubbles in 8, 9, and 10. We've seen real estate and stock price bubbles over the last 7 years. The Fed says it does not manage asset price bubbles. It should manage asset price bubbles, but through monetary policy, it creates volatility in these asset prices. And that's where our tools and techniques come in, because one of the main variables in all of our models is volatility. Okay? We're managing the asset price volatility, which manifests mainly from monetary policy. And we try to manage the business cycle, mitigating the booms, mitigating the busts, creating a shallow circular flow in the overall economy, not creating extreme highs and extreme lows, but managing the economy and trying to get it to grow naturally, over time. Any questions? No? Okay. Will you stop and start, because I want to break these up.